Joining us now on The Debate in New York, New York, Walter Russell Mead, Senior Fellow at the Council on Foreign Relations. And here in studio, Ross Healy, Chairman and CEO of Strategic Analysis Corp. The Executive Editor of Maclean's Magazine, Steve Maish. Armin Yalnizyan from the Canadian Centre for Policy Alternatives. And John Stackhouse, editor of the Globe and Mail's Report on Business. Thanks for everybody being here in the studio. Walter, good to see you again on the line from New York City. I want to start our discussion by playing some tape. Here is the President of the United States, or as Jon Stewart calls him, the still President of the United States, George W. Bush, on what a last few days this has been. Roll tape, please, Michael.
I'm a strong believer in free enterprise. So my natural instinct is to oppose government intervention. I believe companies that make bad decisions should be allowed to go out of business. Under normal circumstances, I would have followed this course. But these are not normal circumstances. The market is not functioning properly. There has been a widespread loss of confidence, and major sectors of America's financial system are at risk of shutting down. The government's top economic experts warn that without immediate action by Congress, America could slip into a financial panic.
Okay, with apologies to our guests here, I got to start in the States because, Walter, we are watching your country with a mix, I think, of astonishment, bemusement, horror, trepidation, pick your noun. Let's get some perspective, because I think anybody watching CNN over the past couple of days would have thought that the world as we know it is coming to an end. Is it, in fact?
I don't think so. The stock market rallied some today. I think we've got some serious problems in the credit market. But if you look at the history of credit markets, you can go back to the 17th century. And periodically, we do have these times when markets kind of get ahead of the ability of both regulators and participants to understand what's going on, to assess and measure the risks. You have these credit bubbles, you have these meltdowns, and we pick up the pieces, try to figure out what went wrong and move on. So I think this is, this is unfortunate but not unheard of.
Boy, unfortunate is not a word that I've heard used a lot lately. I've heard a lot stronger language than that. You sure you want to stick with that?
I'm not running for office, so I might as well just say what I mean. Okay. By the way, I do want to say that at the Council on Foreign Relations, so far as I know, we do not write speeches for any foreign leader. And if we do, we would only give them to one at a time.
Okay, those who know what that in-joke refers to, very good. Ross, there have been a few economic disasters since the Great Depression a long, long time ago. Would you say that this is the worst one since then?
Steve, this is the worst one since then. It's been a long time since the U.S. has suffered the kind of level of indebtedness that it does right now. And indeed, what's happening in the credit markets is having sort of pushed into them for a long, long, long time, led by the Fed, the credit markets are pushing back. They're basically stopping the credit creation problem or process. And with that carries some fairly severe economic consequences.
Well, this started as a financial problem. Now, I mean, it's as much a political problem as anything right now. From where you're sitting, do you think it was a good idea that Congress turned thumbs down on the $700 billion bailout package, or rescue package, call it what you will?
I think there's an awful lot of pushing, toing, and froing about what government should do. But what I find fascinating is that we're in a moment here where corporate America has basically turned that old GM phrase coined by the CEO, Charles Wilson, what's good for GM is good for corporate America, and turned it right up on its head, basically saying what's bad for us is worse for you. And really, for the first time in about 30 years, we're in a situation where the conversation has changed. It used to be that governments were the problem and markets were the solution. And now that markets are the problem, both the Davids and the Goliaths are turning to government and saying, help. So suddenly government is part of the solution and it cannot but act. Something has to happen.
Steve, it's interesting that one congressman said his constituents were split. Half of them were saying no, and half of them were saying hell no. Why is this package so unpopular, the one that's been turned thumbs down?
Bottom line is, to the average person on the street, this looks like a massive cash handout to the very crooks that created the problem. And you can explain to people elements of systemic risk and what it's going to mean for the mortgage market and what it's going to mean for the housing market. At the end of the day, they hear $700 billion flowing to Wall Street, and they think, wait a second, that's my money, and you're giving it to the guys who screwed me. And that is simply not a saleable political message to bring back to your constituents, especially now when so many people in Congress are fighting really tough re-election fights.
That's true. They're going to the polls very soon, aren't they?
Absolutely.
Yeah. John, the temptation is, as Steve put it, to say, to hell with them. They got themselves into this pickle. Let them get themselves out of it. Why is that not a good strategy to take?
Well, the irony is that the bailout package is principally designed to help the U.S. economy, but it's perceived across the U.S. as a bailout of Wall Street. So it's, I think everyone would agree, the worst packaged, worst presented piece of legislation probably in the history of democracies. So yes, Steve's absolutely right that the typical American homeowner does not see this as help for them. The banking system, Wall Street will be fine if Main Street is fine. If the U.S. real estate market can be fixed, if it can be helped to work through what is a gross oversupply now of housing, which will probably take a couple of years, the banking sector and the investment bankers will follow. They'll be fine. But right now, no one in America, or very few Americans, especially out in the heartland, see the effort in Washington as anything to help them keep their homes, pay for their homes, avoid foreclosure.
Let me follow up with Walter on the Washington angle, because it's obvious the President of the United States has very little political capital to spend these days. It looks like the Chairman of the Fed, Ben Bernanke, and the Secretary of the Treasury, Henry Paulson, put the full court press on, and yet Congress seemed to have very little difficulty turning down what all three of these gentlemen said was, pass this or we're going to hell in a handcart faster than you know what. Who has got the currency in your country to sell this kind of a rescue package now?
Well, it's interesting because it wasn't just the current administration. Both presidential candidates, Senator Obama, Senator McCain, Nancy Pelosi, the Speaker of the House, and Harry Reid, the Majority Leader of the Senate, were all rallying around the package too. So I think this is making very clear what a lot of people have been talking about, that Americans average American is feeling that the country's going in the wrong direction. There's been some tendency, I think, to say, oh, it's that awful Bush administration, and a lot of it is. But it's important to remember that Congress's approval ratings are only half as high as Bush's. So that, in fact, the Democratic Congress is more unpopular than this lame duck president with all of his problems. So what we've got now is a general sense in which American people are not really confident that any of their leaders understand what they're facing or know the right way to go about it. I think, and I think their lack of confidence is realistic, given again how badly this proposal was both crafted and proposed from a political point of view. And it was as if the people who did it spent all their time talking to Wall Street, to the elites, to those of us who were talking heads on TV, most of whom can look at the package, see that ultimately it will help the average American, and are willing to swallow things that we don't like to support it. But people who don't know a lot about how the securitization of the housing market, loan market works, don't understand the role that their home mortgage plays in the financial structure of the country, they are suspicious, they smell a rat, and they're not in a mood to trust.
Follow up on that if you would, John, because we heard all sorts of speculation today about why this package failed, from everything that Walter just mentioned to the Speaker, Nancy Pelosi, gave a kind of a stinging speech against George W. Bush, and some of the Republicans felt like sticking it back to her.
Well, it became the perfect magnet for criticism from both poles of the political spectrum in the U.S. So for even to Bush's own comments, any self-respecting conservative would be appalled at this, and Bush looked to be swallowing his words as he was trying to give them. And of course, to the people on the left, this is a corporate bailout, which again is a misuse of public money. Most of the people on the left, even in Congress, are for some form of intervention, but not channeled the way that the $700 billion is.
I mean, I don't think I'm giving away confidences here when I say you're probably not one of the president's hugest supporters. You're not a small c conservative. Having said that, are you taking how much delight are you taking right now in the fact that America, which has been governed in a fairly conservative way from the administration's point of view anyway over the last 8 years, is now having to come in and kind of socialize these losses off Wall Street?
Well, I'm struck by your thinking that I would be thrilled by what's happening. This is actually quite a tragedy that's happening to the assets of
don't misunderstand me. Don't misunderstand me. I'm just wondering if,
No,
if you're
what I
taking
find really,
any satisfaction in the president being as kind of rebuked as he has been lately.
It isn't really a rebuke of the president. It's a rebuke of this hands-off-the-wheel type of capitalism, where basically markets can do no wrong. And what we're seeing is, credit markets really overreaching and having this kind of implosive effect. There's three sets of players here. As John said, there's the underlying fundamental, which is what's happening to housing prices and the assets behind mortgages. But there's also the bankers that lent the money lenders to begin with, and the people that invested in, hey, this looks like a really sweet deal. So these three sets of players are suddenly embroiled in a way that nobody really expected to see this kind of rat's nest develop out of it. And the striking thing is that the government now knows it can't not act. In fact, the package is being badly characterized as a bailout. It can be viewed as Wall Street welfare, but it can also be viewed as the stabilization that's desperately needed to make sure that the wind down of housing prices isn't so precipitous that it just makes values evaporate. And that's what they're trying to do. They're trying to stabilize the wind down of the housing bubble so that the architecture that's been built on top of that doesn't collapse on itself. And that's exactly what government should do, to help an orderly wind down of the market. So when you take apart the package and you look at what's inside there, well, there's the Federal Deposit Insurance Corporation going from $100,000, insuring people's money from $100,000 deposits to $250,000. That's not a Wall Street bailout. That's an insurance package. The $700 billion package as a whole is not taxpayers' money going out. It's basically hedging your bets. Those assets have been bought at a low price. You're betting that those prices aren't going to go too much lower and that they will eventually actually regain in value. And if that's the case, the American taxpayer is actually ahead. There are profits to be made
Potentially.
once the market recovers. So what this is trying to say is we're putting a floor under it. This isn't sapping money from you. It's stabilizing the system. And that's why the term bailout has been such a bad characterization of what this package is about.
Okay, fair enough. But I think, Ross, it's fair to say that most people seem to think America is in this predicament because of greed. And I want start off by, let's have some discussion about this, and I want you to start off by telling us who saw this coming.
I think a number of people actually saw this coming, and those are typically people, Steve, who actually read balance sheets, of which I actually happen to be one. And we have been tracking the massive deterioration of really what I would call the U.S. balance sheet. But it's a deterioration of the household balance sheet because of over-indebtedness on the mortgage side. There's sort of been an aneurysm, I like to say, of the mortgage debt, which just bulged out in the last few years and is really crippling the consumer. And then there's been just a staggering aneurysm on the financial indebtedness side for the banks and the hedge funds and all of those derivatives, which has sort of raised the overall level of indebtedness so much that it's now a great kind of a mill wheel sitting on the economy. If they're going to get out of this mess, you've got to start dealing with the debt. You've got to start getting rid of it. And that's unfortunately easier said than done.
Apparently that's right.
Because as people who own houses are finding out, and for that matter, people who own stocks as well, if you own a house on margin and very, very thin margin, and the price of the house falls, the price of your mortgage doesn't fall with it. So you're left with the debt and no asset. And that's the worst kind of circumstance.
But let me go to the two journalists on this, because you two are running two of the most significant publications in the country, both of which keep a keen eye on markets and financial issues. Did you speak to experts a year ago, 2 years ago, who said, well, watch out, this is coming?
In February, we ran a cover story that you can go back and check. It was called Kiss Your Assets Goodbye, What a Global Market Meltdown Will Look Like. And I don't want to pat ourselves too hard on the back, but this is exactly the nightmare scenario that people like Nouriel Roubini and Peter Schiff and a handful of others, Eric Sprott here in Canada, have been warning about it. And it's exactly the systemic problem that Ross is talking about, a bulge in debt that all of a sudden turns around and boomerangs back on you. But there's one subtle point in this that I think is important to make. People keep on talking about the failures of the market. What I would argue here is what we've actually got is an absence of a market. One of the things that is key to having a functioning market, and one of the things that makes the stock market work, is transparency. It's knowing exactly who owns what assets, what those companies that trade on the stock market are earning, and what kind of cash flows they have. In this case, in the mortgage market, it was centered in the derivatives market. They created all kinds of exotic securities like collateralized debt obligations and default swaps that they don't trade on the market. Nobody got to know exactly who's holding these things. Nobody knows who's holding how much, who's got what trades with whom. And as soon as it started to go down, it's that scenario that creates the fear that grinds everything to a halt that we've got right now. And that is a failure of regulation, absolutely. But it's an absence of a market. It's not like, as George Bush said, the market isn't working properly. We never created a market for these things, so it shouldn't be a huge surprise that it's come back and bitten us.
John, we had Nouriel Roubini here, and I'm sure some people watched the program and saw him prophesying all sorts of doom and gloom and just thought, he's overdoing it. Sure. You see a lot of that too?
Well, there were two big trends that I think a lot of people caught on to as the macro trend, which was this creation or expansion of liquidity over the last 7 years. And there was a lot of serious concern growing through 06, 07 about that. But there was also on the ground another interesting trend that probably fewer people caught on to, which was the malpractice in the mortgage business that really was throwing fuel onto that liquidity fire, so to speak. This is people going out, pushing mortgages on people who really didn't have any business owning a home, being able to buy homes, not only with no money down, but not having to pay anything for, say, the first 18 months, and then getting hit suddenly with a balloon payment, which of course they couldn't meet. And you got a whole whack of foreclosures starting to hit, especially last year.
Well, Walter, let me go to you on that, because that speaks to a kind of a philosophical view that many Americans had, many people certainly in this administration, that the American people are entitled to be homeowners. It saw a kind of a view of society as an ownership society. Is America reevaluating the idea that, you know what, being a tenant isn't such a terrible thing at the end of the day?
Well, I think a lot of people might be doing that in the short term, but no, I think the sort of ideal of home ownership is still pretty deeply ingrained in the American psyche. And again, we've had many booms and busts in the housing market and the mortgage market in the past, and none of them shook this deep faith. But I think it is important to see that what we had to some degree was government regulation, government policy actually helped make this problem worse, because Fannie Mae and Freddie Mac are the two sort of quasi-public, quasi-private organizations who are there really to facilitate the mortgage market. They're part of a vast array of American government programs aimed at helping people have houses. And these programs, which includes a very generous tax deduction for your mortgage interest, have encouraged a lot of Americans to invest more heavily in housing than they otherwise would. And also partly because a lot of people thought it was a great idea to try to give more low income, and especially in the inner cities, people a chance to get a stake in the system, to become owners. There really were a lot of these programs made available. Fannie Mae and Freddie Mac became much more flexible about accepting some of these marginal loans for securitization, and that helped light a fire under this kind of mortgage situation. So we've got, in a sense, what we had was, on the one hand, government policy helping to create, and very bipartisan, Republicans and Democrats all in favor of this, doing everything in a sense to create a housing bubble, including greasing the skids in a way under the credit markets. And then on the other hand, not thinking through the consequences of these risks, especially, as we were saying, credit markets were becoming, with explosion of IT, with increased globalization of finance, with massive pools of liquidity, especially in Asia and the Middle East, looking for homes to go. You had a great hunger for products. And there don't seem to have been enough people in the regulatory agencies thinking through what all of this meant and what you needed to do over here to compensate for what you were doing here.
Understood. Armin, you wanted to say.
In fact, you just put your finger on the hot button. It is about the demand for product. Both in the United States and in Canada, you've had average incomes stagnant for 30 years. But the costs of housing sure haven't been stagnant for 30 years. They've been eating up a bigger and bigger share of incomes that are not only not rising in the middle, but they're actually dropping for the younger generation. That's true both sides of the border. So you think, who's going to be the new homeowner? Who's going to be the people that are going to go in for these new exotic mortgages with 0 down, 40-year amortization? It's people that really don't have a lot of money. Hey, it's our kids that are trying to move out of home. It's new immigrants coming here trying to get into the market without any credit. It's young women that are trying to find financial security. And it's people trying to hedge against jobs that there's no guarantees for life in jobs anymore. So you use what money you've got. Instead of having unaffordable rent, you have an unaffordable mortgage, but maybe you have a piece of equity you can cash out if things go tits up. So it's really not just.
Can you say that on TV?
Yeah,
I
I just
yeah.
did.
Yeah,
You can't. I can't. But in any case, it's a function of who's in these markets for these very difficult terms. And the fact is, the fundamentals mean that if the interest rate ticks up a little bit or unemployment goes up a little bit, you're looking at a fantastic set of losses.
Yeah. Ross.
I thought you were going to talk about the demand for product on the other end, the people who, with Freddie Mac and Fannie Mae, you had loans that were guaranteed by the U.S. government, but they earned a little bit more than Treasury securities. So there were a lot of economic forces wanting to push this market.
Yeah, well, with more and more volatility in the stock market, you're looking for safe havens, aren't you? As an investor, that makes perfect sense.
Ross, come on in.
You know, for a long time, like all of this actually made sense. Because as long as housing prices were going up at 5, 10, 15% per year, it made absolutely perfect sense to get people who couldn't afford it into a house, because 2 or 3 years, and they were up 30, 40%. And suddenly they had this major stake. The problem is that what happened as the bubble just sort of kept going and going and going is that all the standards, all the FICA standards, for judging whether you are entitled to a mortgage or not, they just all went by the board, and they just looked at the capital appreciation of that.
Let me follow up on that, because I know everybody loves to crap on the administration right now and on Wall Street and the Treasury Secretary and the Fed and Fannie Mae and Freddie Mac. Is anybody here on the right-hand side of the table going to look at the American citizen, the taxpayer, the would-be homeowner who has, frankly, no financial business owning a home, and saying, you know what, you shouldn't have been doing this?
Well, and let's remember, in terms of complicity, in the United States, it's a very different proposition in terms of the risk for a homeowner than anywhere else in the world. You can buy a home and you can walk away from your mortgage with very little consequence. A completely different story than for Canadians, where if you walk away from your mortgage, that's going to haunt you probably for the rest of your credit life. That doesn't mean that tens of millions of Americans were willingly walking away from their houses, saying, you know what, screw the bank, we'll skip town and buy a house somewhere else. But many Americans, millions of Americans, were and probably still are very happy to live by those rules.
Steve, what about that? Was there a sense of entitlement that, you know, I'm entitled to own a home even if I can't afford one?
I think absolutely. And I think also there is a small amount of outright fraud that happened. I think everybody acknowledges that. People with no principles went out there and took advantage of people who did not have a sophisticated understanding of their finances, to put it lightly, and convinced them, you can do this. You'll be fine. Trust me, I wear a tie and a suit every day. I've looked at the numbers, just signing the dotted line. That happened. But there was also a much, much bigger group that decided to suspend their disbelief, to just go along with it. They saw their neighbors, wait a second, that guy, I know where that guy works. He doesn't make as much money as me, and yet he's got a 5-bedroom house. I'm going to get a 5-bedroom house, and that fed into it and created exactly the kind of demand for product that Armin was talking about. And on the other side, Wall Street and all the lenders were more than willing to extend that credit, because they knew that in the derivatives market they had this wonderful black hole that all I need to do is get that signature on the paper, I collect my commission on the sale, and send it off to the derivatives market, where it disappears magically. Well, guess what? You blasted it off into space, and now it's raining back down on our heads.
And it was easy to be able to afford this because as the housing price went up, you could simply borrow against it, so you could always get cash.
Yeah.
So
I know you don't want to blame the victim here, but is it fair to say that America needs to re-examine this whole culture of entitlement that this generation appears to be going through?
I don't think it's about a culture of entitlement.
No?
I think it's about a culture of over-leverage, and it is not restricted to homeowners, and it isn't restricted to the little guy. It goes right through to the banking system, to investors. The whole culture is not just individual consumers being entitled to over-leverage. It's banks and huge financial instruments. It's a bit rich to say people are not entitled to try and own their own home when others are entitled to try and make a pretty penny off of that effort. So I just don't buy that it's about people shouldn't try and securitize their own life by having a financial asset. They might have been overextended, but tell me what aspect of American life isn't overextended
Well,
right
this is it. Does America need to re-examine this whole issue of being overextended? Because they are.
Well, indeed. Sorry.
Go ahead, Walter.
Okay, well, I think first it's important to understand that most Americans who've invested in homes have made and are still way ahead of the game. So that the people who are in trouble are people who did these marginal mortgages or who bought their houses relatively late in the asset bubble. For 80% or more of American homeowners, they still look at their home and maybe it's gone down 15% from where it was at the peak, but maybe they're still 50, 60% ahead of where they bought it 10 years ago or 20 years ago, even more. So, this is, it's not a crisis that affects the whole society in exactly the same way. In terms of the over leverage, again, what I'd say is this is the classic problem of credit markets that takes us right back to the 17th century. The magic of credit is that it allows you to operate on leverage. And so banks would lend out a lot more money than they had in a vault, and then something would happen and everybody would come back and try to get the money out of the vault and it would be gone. It's human nature to try to get as much money as possible for as little work as possible. And what happens is that periodically, over and over again, societies, individuals, firms overextend themselves. Something happens, bang, the consequences come home to roost, and everybody learns the lesson. And then for the next 10, 20 years, we're more cautious, but a new generation grows up and they don't remember what happened the last time around. This is kind of standard operating procedure, I think, rather than some hideous, unique flaw that has suddenly appeared in our time.
Well, let's see if this hideous, unique flaw is restricted to south of the border or whether we're having this here too, Steve. Of all of what we have been saying tonight about what's been going on down there, how much of it is applicable to what we're experiencing up here?
Well, a lot of it, but not to the same degree. I think that what you can basically look at is that all of the same trends exist here, but you don't see them to the same extent. Canadians' reliance on debt, for example, has been rising pretty steadily over the past 10, 20 years. It's getting to the point in certain places, and our real estate market is a prime example, where it's arguably getting ahead of itself. For the past 5, 6 years, especially in the past 12 months, as we've seen the housing down the south go south,
Mm-hmm.
People have been saying, well, don't worry, we're safe up here. Well, now it's getting to the point where you have to look at it and say, well, we might not have the massive foreclosures that they have down in the States, but I think we could certainly have a pretty serious correction.
Mm-hmm. John, the kind of expectations they had down there, do we suffer from that same kind of thing and lower savings rates and indebtedness, that kind of thing?
Not nearly as much. I mean, you look at any of the credit statistics comparing the U.S. to Canada, we're still a significantly different culture. But that doesn't mean we are completely different or alien to these notions of debt, or that we'll not be sideswept by the economic downturn in the United States. I mean, one thing to bear in mind in all this discussion about debt is that debt and its meaning depends greatly on the ability to repay. It depends entirely on the ability to repay, which depends on growth. And what some people have lost sight of in this debate is that the economy, the North American economy, has slowed down very significantly over the last 4 quarters. So people's ability to repay, companies' ability to repay has been greatly impaired. If we look at, if we're looking at an extended downturn or possibly an extended recession over the next year, maybe year and a half, according to some people, then, especially in the Canadian context, the pressures of debt become much more serious because our ability to repay our debts is more greatly impaired.
Ross,
I think what saves Canada from suffering the same catastrophe as the U.S. is that our banks actually, not entirely, but they pretty much maintain good banking discipline all the way through this. And partly that's on account of the fact that way back in 1982, at least two of our banks nearly went to the wall with that LDC debt stuff, and then they had to work their way out of it. So it's kind of imprinted on the psyche of Canadian bankers that if you get yourself into trouble, it can be a heck of a long, tough workout. And so they haven't done that. And if there's a saving grace, that's it.
But Walter, the one piece of advice I suspect most of us remember George Bush giving Americans vis-a-vis their economy was just after 9/11, when he urged everybody to go out and spend, go out and shop, go out and pick this economy up. Where have the voices over the last, how long has it been now, 7 years, been encouraging people to go out and save or go out and pay down debt? Because you don't hear those.
No, it is interesting. I mean, if you look at the American economy, we've had the two longest expansions in our history, one after the other, really going back to the Reagan administration, with just two very, very short and mild recessions from about 1984 to 2008. If you compare that to the economic record going back to any point in our history, it's been a long, smooth, comfortable ride. No storms, no trouble. So I think what you've had is a whole generation and more growing up in a world that isn't disciplined the way that, the credit cycle used to get a recession every 7 years, and it was a bad one. So I think what we've seen is a society that's forgotten how important it is to get certain things right, and is now having a rather sharp and unpleasant reminder. My guess is that you'll see Americans moving forward a little bit more cautiously if this thing continues to sort of drive us into one of these deep and painful recessions.
Okay, we've got about 3 minutes left here, and I want to put one more issue on the table, and to do that, I'm going to ask the President to set it up for us again. Roll tape, please.
In the long run, Americans have good reason to be confident in our economic strength. Despite corrections in the marketplace and instances of abuse, democratic capitalism is the best system ever devised. It has unleashed the talents and the productivity and entrepreneurial spirit of our citizens. It has made this country the best place in the world to invest and do business. And it gives our economy the flexibility and resilience to absorb shocks, adjust, and bounce back.
Let's go briefly around the horn on this. Armin, to you first. Do you agree with the President that democratic capitalism is still the best?
Yeah, that's why they're struggling over what kind of a bailout package to have in the U.S. That's what democracy is about.
Not quite as sold on it as you once were?
No, I think, in fact, the economic fundamentals of the whole globe are really good. More and more countries are coming on stream that are both producers and consumers. We are looking at a long wave of expansion, and this is an unpleasant hiccup, and it might last for longer than we like. But in fact, we're looking at a whole new world order unfolding, and the more democracy is embedded in capitalism, the better for everybody.
Ross.
And speaking on a global basis, Steve, most of the rest of the world can absorb a great deal more debt than it's currently carrying. The U.S. cannot absorb any more, but it can transfer it off its own balance sheet and overseas. And if that's the case, then I think that there's a long-term case, a very, very bullish long-term case for a huge global expansion.
Steve.
I agree entirely that democratic capitalism is the best system. The only thing I disagree with is the outlook for the American economy, because I think that gradual shift of debt to other nations implies a massive restructuring of the world economic order. And that is going to massively change the American standard of living going forward.
Absolutely.
Yeah, go ahead.
Yes, best system with a sensible amount of regulation. I think that one of the great dangers out there is that many parts of the world may start to question democratic capitalism, back away from it, or maybe move to new experiments in both democracy and capitalism. We're starting to see interesting things happen in Russia, for instance, that may impair greatly global growth over the next few years.
Walter Russell Mead, you wrote the book on this stuff. You think the President's right? Democratic capitalism is still the best, bar none?
Well, I guess I feel a little bit like Winston Churchill. You know, he said democracy itself is the worst form of government except for all the others that have ever been tried. And this is about the worst possible way to run an economy except for the ways other economies have been run in the past.
That line still holds up all these years later, doesn't it? It really does. Okay, let me thank everybody for participating in our discussion today. Walter Russell Mead from the Council on Foreign Relations in New York City. It's good to see you again, sir. Hopefully next time under happier circumstances. Thanks for being there, Walter. And on the left side of the table, Ross Healy from the Strategic Analysis Corporation and Armin Yalnizyan from the Canadian Centre for Policy Alternatives. And our two journalists on the right, Steve Maish from Maclean's Magazine, John Stackhouse from the Globe and Mail. Thanks, everybody.
Thank you.
Support Ontario's public television. Donate at tvo.org.